The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Scorebox. I'm Steve Sedgwick, and these are your headlines. The crash of a Jeju Air Boeing jet becomes the worst air disaster in South Korea's history. Safety concerns sending Boeing shares lower in early Frankfurt trade as a probe into the incident begins. European equity markets following Wall Street low, with every sector in the red, putting the benchmark Stoxx 600 remaining on track for a second straight positive year for the first time in almost a decade. Mixed fortunes at the end of 2024 for some of Asia's largest markets, with the Nikkei rising almost 20% on the year, while South Korea's KOSPI posts its longest monthly losing streak since 2008. And condolences pouring in for the former US President Jimmy Carter, who has died at the mighty age of 100 at his home in Georgia. The more I read back at the extraordinary life of Jimmy Carter, the more I think he is one of the most fascinating US presidents. I mean, blighted by concerns about what happened, of course, at the tail end of the 70s. The economy was in trouble. There were inflationary concerns. There were huge geopolitical issues going on as well. But he was there for a lot of it. Do you know, he was actually the man. People talk about the Reaganomics and the Reagan Revolution economically. He was the man. Jimmy Carter was the one who actually appointed Paul Volcker. Isn't that interesting? I didn't know that he instigated that era, the Volcker era, so to speak. Anyway, the former US President Jimmy Carter has, as I'm sure you're aware now, passed at the age of 100. Carter served as the 39th US President between the years of 1977 and 1981 and won a Nobel Peace Prize for his humanitarian efforts. World leaders have paid tribute to the former president. The United Nations chief, Antonio Guterres, said his leadership contributed to international peace and security, whilst US President Joe Biden described him as a man of principle, faith and humility. NBC's Mark Barger has more.
I, Jimmy Carter, do solemnly swear.
Jimmy Carter personified the American dream, rising from farm life in the rural South to become the 39th President of the United States. He was born and raised in the small hamlet of Plains, Georgia. After serving in the U.S. Navy, he returned home to Plains and made a success of the family's peanut farm. He also met Rosalind Smith, the woman who became not only his wife, but his closest advisor. Carter began his political career as a Georgia state senator before winning the governorship.
The time for racial discrimination is over.
He ordered a portrait of Martin Luther King Jr. displayed in the Georgia Capitol.
My name is Jimmy Carter, and I'm running for president.
Carter's 1974 campaign for the White House began as the longest of long shots. In the wake of Watergate and Vietnam, his appeal as a straight-shooting Washington outsider grew, and he narrowly defeated Gerald Ford in 1976. The Carter presidency was highlighted by the Camp David Agreement, bringing a once unthinkable peace between Egypt and Israel. But economic recession and high interest rates crippled Carter's term in office, and the Iranian hostage crisis devastated it. Americans grew frustrated with Carter's handling of the situation, including an aborted rescue attempt that eroded confidence in his leadership. Republicans capitalized in 1980 as Ronald Reagan's sunny optimism ended Carter's re-election bid with a resounding victory. But from that defeat, a remarkable second act. Private citizen Carter began a new career, helping build homes for the poor in America, making Habitat for Humanity an international name, even while focusing on global humanitarian causes. In 2002, Jimmy Carter won the coveted Nobel Peace Prize. But in 2015, at the age of 90, he announced he was diagnosed with melanoma, which had spread to his brain.
But I was surprisingly at ease. You know, I've had a wonderful life. I've had thousands of friends.
Carter underwent cancer treatment and recovered, remaining active well into his 90s, teaching Sunday school at his South Georgia church. Even after suffering a series of falls, Carter's resilience allowed him to continue building homes for habitat.
I'd say peace and human rights and treating everybody the same has been what I hope will be my legacy.
By the end of his life, Jimmy Carter had won the deep respect and admiration of not only Americans, but people around the world. Mark Barker, NBC News.
Let's take a look at where the US markets currently are, and this is where we saw the last move as well. Down 300 points for the Nasdaq, 66 points for the S&P and the Dow. I'll make the point again, though, on this one, that actually the rotation story, and I'll mention this because I know our next guest wants to talk about this as well. The rotation story, we keep talking about the broadening, about the looking at the other 490 stocks in the S&P, about other sectors as well. Well, quite frankly, that has been a really tough trade to justify, certainly in the last month. Again, I'll make the point. The Nasdaq was up 2.6%. The S&P was down 1%. The Dow was down 4%. Now, I know the Dow, a lot of that was about one stock, and that's why I've been berating and bemoaning the fact that the Dow is a fairly useless indicator of the broader American market. But energy, for instance, over the last month, down 10.7%. We talked earlier about materials being under pressure. Material sector was down 10%. Industrials down 7%. Real estate down 9.4%. It was the technology names that rallied yet again over the last month. Let's take a look at where the European equities are currently trading. And do you know, I didn't actually expect it to be down quite as much. A lot of the spread better calls were for fairly flat, a little bit negative, but we're down 0.4%. Again, the legacy from the US was a -1. Individual sectors, we didn't have any sectors in positive territory last time I looked. We still don't. The best of the bunch, I'm afraid, is travel and leisure. And I doff my cap to any of you who've gone near an airport in Europe over the last few days. It's busy, is all I can say. And there was a lot of weather-related delays as well. So it's been challenging for all of you who've gone near an airport in Europe over the last couple of days. Telecoms trading around the flat line, real estate around the flat line, and utilities as well. Sectors which are under pressure. We can see the autos last time we looked were under pressure. They're actually off the worst four sectors now. Technology, healthcare, industrials and media all down. Nick Nelson is head of global equity strategy at Absolute Strategy. Nice to see you, Nick. How was your Christmas?
Very good, thanks, Steve.
A little birdie tells me, well, it was you, that you did all the cooking.
Well, yeah, why not?
Congratulations, well done. I'm like the house elf. I help out, but I don't do much of the cooking, which means that all my guests went away without food poisoning, which is good.
That's good.
In terms of the broader outlook, you said to me, you're probably sick of broader outlooks, but I think this is the time of year when people they're playing with their portfolio, they're working out whether they want to carry on running their tech trade, whether they need to diversify. I've just twice now in the last half an hour talked about why the diversification strategy has been challenging. But just give us your broad brush outlook.
Yeah, so the broad brush for us is we think it's right to stay risk on into 2025. So we've been basically overweight equities since Q1 this year. So we've run this rally. We've seen the S&P up almost 25%. So I'm not surprised we're feeling a little bit of a pullback towards the year end. But we think actually you've got a very benign macro backdrop. Growth reasonable, but not too hot, sort of 2.5% sort of GDP for the US. We think the policy response in China will help a bit. We're not necessarily China bulls, but we think you'll get 4.5% growth there. And even Eurozone, obviously growing more slowly than those two other regions, is going to do okay and certainly avoid a recession in our view. So you have that relatively benign macro backdrop, a couple more rate cuts coming in at the same time. And then the third leg of the stool, and this is the critical one, is that the earnings come through and you start to see corporates delivering on profitability. And that's the real key.
I'll hold off on earnings because I know that's one of your specialities and I've been plugging away with you in many years about. But the broader, you said something there, the broader outlook is benign, the macro is benign. As not a pessimist, but someone who's, maybe I'm a pessimist, I don't know. But as a journalist, let me challenge that as well. I don't think the macro outlook is benign. I think China is in a tricky position. There are certain sectors which are phenomenal in China. I make no bones about it. The EV sector, phenomenal. But the Chinese consumer refuses to spend money. I doubt very much, in my own humble opinion, that China is growing north of 4%. It just doesn't feel like it, looking at what's going on with global trade flows, look at products that are going into the country, etc. as well. I think Europe is in recession in parts rather than a skirting recession as well. And I think the US, you could possibly argue, has had the best of it. And the consumer is as maxed out, certainly in the bottom third or certainly the bottom half, as it's going to be as well, and they're beginning to struggle. I've challenged you on many fronts.
Yeah, no, that's fine. Look, I mean, I think on the US, you're right. There has been this bifurcation with the wealthy households and the lower income households, and that's been going for a long, long time, but that's been exaggerated by some policies. We would argue still a couple more rate cuts to come. We'd also argue, looking at the corporate sector, you have got this situation where default rates seem to have peaked. And it seems it's a very rare stage of the cycle to see sort of corporate profitability improving, default rates peaking, and the Fed still cutting rates. So it feels to us that there's been a little bit of a disconnect in terms of the timing.
How can you say that if the consumer is going to carry on finding it trickier from here? Again, there are different reports about the state of the US employment market. But if the consumer is still under a bit of pressure, a large number of consumers, I appreciate rich people are going to get lots of tax breaks, that's fine. How can we say that the default rate on US corporates has peaked, given the fact that 2/3 of the US economy is facing that consumer?
So consumers clearly key. I mean, what we're looking at, sort of the high yield default rates, which have rolled over, the bankruptcies, the data we have on that, they've rolled over as well. And really, for looking at it from the corporate perspective, we think unemployment rates do not rise significantly from here. And that's the key, right? That's the game changer for consumers, right? If you lose your job, that's when your consumption patterns change dramatically. So keeping employed is the key factor. And we would argue that when such a high profitability, high margin world for corporates, with corporate profit share as a share of GDP up to sort of 50-year highs, it's a very strange scenario for companies to suddenly start doing these mass redundancies, laying off workers. So if they can keep the workers, if the workers can keep their jobs, consumption's okay, and they're all, the economy continues to move on. And on Eurozone, just one word on that, I think the periphery is doing a lot better than the core. So I'd agree with you, there's weakness in the core.
I'll come back to Europe. I'll come back, and actually the core being, let's be brutally honest about it, Germany we're talking about in fine part. But again, some data I found earlier on as well. Credit card lenders wrote off $46 billion in seriously delinquent loan balances in the first 9 months of the 2024. This is in the FT, but they're quoting bank reg data. The figure is up 50% on the period last year, and the highest in 14 years. But Nick, this is with Americans keeping their jobs.
Yeah, and the credit cards, again, it's been if you look at the population, it's not been the higher income households that have been maxing out on credit cards.
No,
it's the bottom part of the economy.
It always is, isn't it?
It always is. And there's some stress and tension there, undoubtedly. But in the whole, we've actually seen the consumer do pretty well in the US, and that labour market data seems to us to be actually stabilising rather than deteriorating.
I rudely interrupt you about your point about the Eurozone periphery versus the core as well. I absolutely, periphery's done far better than the core, but the core is the one that matters because it's the core.
The core's the big way, yeah. I mean, I think for investors, though, there's quite an interesting call to make, and we've had that view through most of this year and continue it into 2025. Spain in Q3 looks like it grew more quickly than the US, right? Growth almost 3.5% GDP growth. There's proper growth there, and the ECB are going to continue to cut rates, of course, for the core, which, as you say rightly, is quite weak. So think of it like a reverse of the 2012 Eurozone debt crisis, where rates were inappropriate for Greece, Italy and Spain. They were too high. This time round, they're inappropriate because they're arguably, for maybe Spain and things like that, could end up being too low.
All right, Nick, lovely. You're going to stay with us for another chat for two reasons. One, I like chatting to you, and two, I've got no one else. It's just me and you. No, that's not true. There's loads of guests lined up, actually. A number of the guests who actually made themselves available in this period between Christmas and New Year, I think they're like me. They're done with the gluttony.
We all want to work hard, right?
Well, yeah, and it's a funny period, isn't it? Because I'm done with Christmas, but I'm not quite ready to be fully into the work thing, which is nice because my boss gave me an hour's lie-in this morning. Thank you very much indeed to the team. She's laughing. CDU leader Friedrich Merz has criticised Elon Musk over an opinion article praising the far-right Alternative for Deutschland party, saying he could not remember a comparable case of interference in a friendly country's election campaign in the history of Western democracies. Musk also faced criticism from the centre-left, SPD, with the co-leader Saskia Esken telling Reuters that people attempting to influence the election from outside Germany should expect, quote, fierce resistance. Now, in his piece that was published on Saturday in the Welt am Sonntag newspaper, isn't Sonntag Sunday in German? Published on Saturday for a Sunday newspaper. Okay, got it. I knew my German O-levels would come in handy one day. Sonntag, remember that one. Musk claimed the description of the AfD as a far-right party was clearly false, saying it represents political realism and describing it as the last spark of hope for Germany. Fascinating. The incumbent president of Croatia, Zoran Milanovic, has won the first round of the country's presidential election, but fell just short of securing an outright majority. He will face his main challenger, the candidate of a ruling Croatian Democratic Union Party, in a second round scheduled to be held on January 12th. Now, speaking after the vote, Milanovic urged his supporters to back him in the runoff.
With these words, wishes, emotions, which I can't and won't resist this evening after this excellent result, once again thank everyone who supported me. I don't hold it against anyone who didn't, because everyone has lots of faults, as do I, that's normal. I would invite everyone to get out and vote in the runoff, in even greater numbers. And I ask everyone to give me a show of trust, human trust, and faith, and I will do everything not to disappoint them.
I'm pretty sure my team is just testing me with as many obscure pronouncers as possible, or certainly difficult pronouncers as well, just to work out how I am in this interim period. So let's go. Meanwhile, Mikhail Kavalashvili, about a 6, has been sworn in as the new president of Georgia amid a wider political crisis in the country. The new Georgian leader, who is an outspoken critic of the West, was backed by the ruling Georgian Dream Party, a Eurosceptic party which also froze the country's EU application. The outgoing pro-European president described the new leader as not legitimate and vowed to fight back. Coming up on the show, we're going to be diving into the earnings outlook ahead and finding out just how much they've driven performance this year here on Squawk Box. The Dow and S&P are on track for their best yearly performances since 2021. Bob Pisani has taken a look at how company earnings have played a role in driving these gains.
There is a simple answer to why the stock market is ending near record highs. Overall profit margins and earnings remain near a record. The S&P 500 is expected to see an overall earnings increase of about 10% this year. This is the fourth consecutive year of earnings growth, and we're expecting another 15% in 2025. In the last 3 years, but particularly in the last 2 years, stocks in the technology sector have reported much higher earnings than the rest of the S&P 500. This is largely because of the AI story, which has become an investing paradigm on the scale of the internet investing paradigm in the late 1990s. So this is why NVIDIA and Broadcom and Microsoft, Meta and Amazon account for nearly 1/3 of the S&P 500's earnings this year. For 2025, earnings growth for these mega-cap tech are expected to remain strong, but slow down from the torrid pace of 2023 and 2024. So, for example, NVIDIA is expected to see profits slow to a 50% gain in 2025 from a 127% gain in 2024. This is again causing excitement among the rotation crowd. They see hope that the other 493 stocks in the S&P will finally see enough improvement in earnings to entice investors away from the high valuations of these mega-cap tech stocks and into the rest of the stock market. Still, expecting investors to rotate out of big tech and into the rest of the market is a pretty tall order. Even if mega-cap tech profit growth slows down, they are still way above earnings for most everyone else, at least the biggest ones are. And the earnings gains expected in the rest of the market are still fairly small, likely less than 10% for the non-mega-cap tech. It could happen, but it's unlikely to entice a lot of investors back into the broader market.
That is a great package, actually, Nick Nelson, head of global equity strategy at Absolute Strategy. It asks, and I make no bones about it, and no apologies for carrying on asking the same or similar question to you and all our guests, because it is the question. The earnings growth still, the final slate there on Bob's package, showed it's still going to be 18% earnings growth out of the top 7 as well. It's still going to be huge. Not the 24 we just saw, maybe, but still 18. Why would you get out of that? I mean, it's a question a lot of people are asking. Why would you get out of that sector?
Look, I think there's two things here. Firstly, for the overall market, we do need to see earnings come through. We're on 22 times forward for the S&P 500 as a whole, right? So those are full valuations. So it has to be about earnings. And the second point is the question that you're asking, Steve.
7, what's that 22 do?
Well, if you look at you only get a couple of multiple points off. But the point being, if you look at the earnings growth, so expected earnings growth is about 14, as we were seeing there, for the 500. But you take out those 7 stocks, it falls down to about 10%. What I do find encouraging though is we've done some work, we've actually bottom up, added up all of the 500 stocks, looked at a heat map of what their growth, bucketing their growth rates, 0 down, 0 to 5, 5 to 10. Yes. And you actually see over half of them expected to have 10% growth, double-digit earnings growth in 2025, right, 12 months forward. So it is expected to broaden out. We're seeing some tentative signs of it broadening out, and that will give us confidence that we should be having a more of a wider portfolio. Banks, for example.
So we don't need to worry about the valuations because they're going to grow into them.
Well, I'm not so sure about that. I would say the valuations can hold where they are because of the benign macro backdrop we were talking about earlier, reasonable growth rates coming down, which is a very rare occurrence. And secondly, you really need to see the earnings come through, otherwise you could have a valuation risk. So that's your risk, right? You're starting off with high multiples, and certainly for 10-year returns, long-term returns, this is not a great place to start for long-term returns. No. But for 12 to 18 months, you can still deliver.
And our friends over at Goldman Sachs have been talking about I think they're still pretty optimistic for 2025, but over a 10-year period, I'm pretty sure I read that they're only expecting 3% growth in returns, rather than the earnings, returns over the next decade as well. So where are we going to see the big slowdown? I mean, it is there, but it's just not 2025?
Yeah, I think it's later. And I think the valuations at some point give you, you're basically eating the lunch of your future returns, right? Yes. You've taken the multiple.
We're taking money from our children and our grandchildren by having it now.
To a degree, yeah, to a degree. You could put it that way.
We're skiing, we're spending kids' inheritance.
You could put it that way, yeah.
As opposed to Keir Starmer having it.
Okay, exactly. So look, I mean, I think that the fact that you've seen the multiple expansion, which was stage 1 of the process, that can hold where it is, but I don't think we can go much further from 22 forward.
In terms of the individual sectors, again, our viewers are now asking all kinds of questions, including what is the acronym skiing, but look it up. Yeah. I just did it. But in terms of the sectors which we can see rotation into with more confidence that actually they are A, going to deliver on earnings, and B, not have quite as volatile a ride.
Yeah, well, I would definitely look at banks. Banks is our key overweight. I know, we get a lot of pushback on this.
40, I just did JP, Wells, and I put in Citi as well. And all three of them were up. I mean, it was a 41%. Great chart, by the way. Thank you, team. Whoever put that one. Who's Amelia? She's back. She's had a holiday. She's much sharper than me today. That's not hard. Up 30% over last year.
Yeah, but they've been delivering on earnings, right? And that's the thing. And I think people have been, because we're seeing these rate cuts, the normal playbook is rate cuts, net interest margin pressure, et cetera, et cetera. But I think it's much more complicated than that. We think we're getting towards the end. We think there's only two more cuts from the Fed. We're getting towards the end of these rate cutting cycles. They've protected their profitability very, very well. They have done well already. I mean, we've been overweight since Q1 this year of banks, but I think there's more to go. And certainly, obviously, the valuations. I mean, look at Europe, right? We're still well below 1 times price to book.
Oh, come on, Nick. Come now, Nick. Do you know what? I was with you until you pulled out that old trope. How many times over the last decade of you and I, when your old shop and your current shop, argued about price to book on European banks?
But Europe, okay, I'm not saying they're going to go to US levels, but they have got decent return on equity. Yes. They have decent return on equity, and we're potentially seeing some consolidation, which we talked about last time. So we'll see.
Oh, yeah. Consolidation?
Yeah,
lovely.
Potentially.
Yeah, exactly.
Well,
Basically, let's go straight to that. Is Andrea Orcel doing something which I think is fantastic, shaking up the sector, but just to see the appetite. I should go back a stage. Orcel is the boss of Unicredit. He's looked at more consolidation in Italy, but he's most contentiously tried to, I was going to say park the tanks, that's the wrong phrase. Just see whether the German banking, financial and political establishment is ready for cross-border consolidation as well. That's the test case, isn't it?
Yeah, and I think when you look at Eurozone as a whole, that's been one of the things that's left it behind. It's why it didn't exit the GFC as quickly as the US. It didn't have a banking system that was basically consolidated. It didn't have ability to lend, and it had all the restrictions. So I think the banks are interesting globally, and in Europe, of course, if we do get this consolidation, they could finally maybe re-rate a little bit.
But let me just do. We've got 120 on show. I'll do it very quickly then. Price to book as a measure. So you're talking about prices going up, But how about this for a revolutionary idea? And you're going to have about 30 seconds by the time I've built up to it. Why don't we actually mark the book value down? Because it's the wrong price, Nick.
Well, this is the thing, right? But the thing is, price to book, as you know well, if you have no return on equity, it really doesn't matter. You know, that's the reason why we've had these low price to book. So I think that, and then deregulation in the US, pivoting back to the US, deregulation in the US banks is going to be very supportive.
Thanks for coming in.
Pleasure.
It's lovely to see you. Making it all the way from SW15. It's great. Superb. Good to see you, my friend.
Thank you for listening to Squawk Box Europe Express.
For more market moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.